Brian's job was just transferred to a new city, and his wife found a condo perfect if they can secure a $125,000 mortgage. So that's how much they want to borrow. They want to borrow $125,000. Okay, so they go to the bank, and here are the options: a 30 or a 15-year fixed, different percentage rates, right? So they say, okay, we want to borrow $125,000. Let's determine the monthly mortgage payment if they go with the 30-year fixed. So we need the payment equals PMT, 30 years. So we're looking at 0.0425 divided by 12. Got to make it monthly. Now, how many payments? 12 months in a year, 30 years in a car in the loan, and they're borrowing $125,000. If you type that into Excel exactly like you see it, maybe with a prettier multiplication dot in there, snowflake as I like to call it, Excel is going to spit out 614.92. So if they go for a 30-year fixed, they can borrow $125,000 with $614 monthly payments, which is not bad, right? But over the course of 30 years, if they pay $614.92 every month, right, 12 months in a year for 30 years, they're going to pay back a total of $221,371.20, which is not quite, but pretty close to $100,000 more than what they borrowed. All right, that's just 30 years. Now let's think about the 15-year mortgage. If they go 15 years, they would do PMT. Recall that the 15-year mortgage had a 3.5% interest rate, so 0.035 divided by 12. It's only 15 years, so 12 months in a year times 15 years in a loan, and they're borrowing $125,000. Type that into Excel exactly like you see it, and the monthly payments would be $893.60. Okay, but again, it's only for 15 years, so it's half the time. So over the course of those 15 years, if they pay $893.60 for 12 months in a year for 15 years, they're going to pay back a total of $160,848, which is only like $35,000 more than what they borrowed. That's way less in interest, right? So we're going to compare the two. We've got the 30-year, which was $614.92 a month, and a total of $221,371.20, versus the 15, which was $893.60, but only a total of $168.48. So when you're comparing, if you look at monthly payments, well, the 30-year wins the monthly payment, hands down, right? It's almost $280 difference. But the 15-year saves you over $60,000 in the long run. So it's really, really hard to kind of decide which would be better. I don't know, right? It depends on your family. But when you look at the 15-year, why would the 15-year maybe be better? Well, if you subtract these, and I already kind of mentioned this, it would save you $60,523.20 in interest in the long run over the life of the loan. So you might say, well, I won't miss that money if I never see it, right? As I'm paying $614, I have an extra $280 a month that I can live with now instead of thinking over the course of the loan. And that might be true. I mean, you can spin it any way you want to really make it work for you. But that's kind of in the comparison. And anytime you buy a house, you have to make this decision. Can you handle a larger payment for a shorter amount of time? Or if you are like me and you live paycheck to paycheck, you have to go with a smaller amount because that's all you can afford. So it really depends on your financial predicament at the time that you're buying a house.